We're moving on to chapter 3. As with the prior chapters, you really need to print out this handout and make notes on it, as well as make notes on it from your reading. I do not cover everything. I would read through the chapter objectives, and then when you get done studying, read through them again and see if you have understanding of them. I also have the discussion questions, and like the other chapters, the solutions to the discussion questions are at the end of the handout. And if you have questions on it, you can go through with me. So I have put this a little bit out of order so I can get all the definitions on one page with the journal entries on the next page. So we'll be hopping back and forth between these between the definitions. Okay, let's see if I can get this to advance. Okay, the accounting cycle, basically the purpose of financial statements is for external users, and external users use financial statements to compare firms. So if we're going to compare firms, we need to make sure that they are over the same period of time. So that time period that we have selected is a year. So it was just a handy time period that already existed, so we do that as far as the year. So within that year, how we classify, record, and summarize, that's the accounting cycle. So if you walk into a store and you make a purchase, that is revenue to the store. So they're going to record that sale, they're going to classify it as a sale, and then at year end they're going to summarize at regular intervals. So our accounting cycle is the classification, summarization, and reporting of items within usually a year. So here's some steps of the accounting cycle. I would never necessarily have you list them out, but you sort of do need to know what comes in order. You're going to do enough homework problems, and again, accounting is something you have to practice. So you can listen to me do it, and quite frankly, the more I do it, the better I get at it. But if all you do is listen to me, as I tell my students, if all you do is listen to me and watch me, you're a great spectator, but you're not a very good accountant. So like music, like athletics, you can't necessarily, spectating is good. You can get a little better by spectating, but until you practice it yourself, you're really not doing anything. So if you haven't used so far any of the extra practice things I've given for chapter 1 and chapter 2, I would argue you're more of a spectator, and until you actually get down in there and practice them, you're really not learning much. So anyway, so hopefully by practicing it, you don't necessarily have to know the steps of the accounting cycle, but you can certainly in your mind tell, if I give you 2 or 3, put them in order. If you ask any accountant what the steps of the accounting cycle is, they would probably say, journalize the transactions and prepare the financial statements, because that's basically what you do. But notice they have 8 steps, whereas accountants might say there are 2 steps. They may throw in posting them to the ledger, but anyway, so here's the steps in it. So we have to journalize, record the transaction, and thought I added, oh, there it is, journal. Journal is where you originally record the entry at, and you did this basically in the columns in the prior chapter, whereas I said, okay, the owner invested $80,000 cash in the business, so you put it in cash and you put it in owner's investment. We're going to get a little more formal, but that's basically journalizing. You posted it to the ledger. Your ledger accounts were actually the columns in your little spreadsheet that you had going. Then we're going to make a trial balance. We simply did a formal balance sheet at the end because it was there for us, but we would make a trial balance. So we'd do adjusting entries, and we'll go through all of these. So again, come back to this later after probably chapter 4 and see if you know the steps or can identify which one goes before the other. So accounting records just basically keep track. We all have an accounting record to some extent, but we only keep track of cash generally in our personal lives. a business not only wants to keep track of cash, but they want to keep track of their land, their buildings, etc. In our own minds, we don't have to keep track of our house because we have one. However, there are some things we know we have to keep records for tax purposes, like our investments, and maybe even sometimes if you know you're going to buy your house and sell it soon, you want to know if you made a profit on it. So you're going to keep track of what you bought it for and what you spent on it. So basically, accounting is just kind of an expansion for a business of what you already do with cash. So you can read through that. The ledger is, if you think back to the prior chapter where we had cash and all those transactions underneath it, we had land and all those transactions underneath it, accounts payable and all those transactions underneath it. The journal would be the actual transactions, and we wrote them in columns, but hopefully you can visualize that spreadsheet would be huge, not only horizontally because businesses have thousands of accounts. I worked on Quincy University's accounts once. We have like 9,000 accounts, mainly because each individual area, the School of Business, the library, think of every department there is, has its own supplies account, has its own salaries account, etc. So when you're duplicating accounts like that by area, it can become quite unwieldy on a spreadsheet where you would have literally thousands of columns for each account. And then transactions, just think of the amount, just walk into a store and watch the number of people go through the checkout. And that's only sales transactions. So it certainly have a lot of lines too. So those financial statements would become, if we kept track of them on an Excel spreadsheet, would become rather unwieldy and subject to a lot of errors. But for our purposes, the ledger would be the entire column. So the journal would be recording where we'd record the owner's investment by cash. But the ledger would be, if I asked you in the prior chapter how much cash we had, you could just simply go down the cash column and say, okay, we have this. Okay, so the ledger is the individual group of accounts. And I'll talk a little bit about this later. Okay, so each account has three elements, a left side and a right side, debit side and a credit side. Okay, so we're going to go to this. So a formal ledger, let me pause here a second. Okay, I just looked online to get a picture of a ledger. Notice this is the cash page. So on the cash page, the ledger has a date, it has a description. This is just the page number in the journal, so I can go back later and find out the details of that. And then the debit column and a credit column and a balance. So we don't use a formal ledger much anymore because the computer does a lot for us. But I want to show you something and use my drawing tool here. If I just do this, draw a line there, and draw a line there, and write cash above it. Didn't do a very good job of writing that. But basically, some of this information, while important for our purposes in quick reporting, etc., these are the important things here. And then I could just draw a line underneath it if I want the balance and put 5,000 minus 2,000, or 500 minus 200, and get 300 on this side. And notice they do the balance out there. So this is what a ledger looks like. So back before computers, businesses actually had like 3-ring binders where they had a separate page for every single account. So if I had a cash page, a land page, an accounts receivable page, and every time I would make a recording in my journal, then I have to come and post it to the ledger, and I'll show you that in just a second. But it's very time consuming, and the reason I say they used a 3-ring binder is because you never knew how many pages of cash you would need on January 1st for December 31st. So when I'd fill up this page, I'd just get to another cash account. So you can see I have the balance. Just transferring all these numbers was very time consuming. So this is the ledger. The ledger is where I keep track of specific accounts. So if I wanted to ask this person how much cash she would have, they would open the ledger page for cash and go to see 300. Okay. So we use T accounts to kind of pretend they're a whole ledger page. but we just want the balances on those. So this would be where cash, and this is the left side or the debit side, and the right side or the credit side. I want to talk a little bit about debits and credits. So the journal is the book of original entry where we record it first, and the ledger is where we keep track of specific individual accounts like cash, accounts receivable, etc. All right, this is where you record the transaction itself. So if I recorded cash and owner's equity, then cash for 80,000, then I go to the cash ledger page and indicate cash went up by 80,000. And then I go to the owner's equity ledger page and indicate owner's equity went up by 80,000. So again, note the time-consuming nature of that, and the computer does that now for us. Okay, so on to debit and credit. Debit just simply means left, and credit simply means right. Please get out of your head the idea of the debit and credit like debit card and credit card, and we credited your account and we debited your account. Pretend these mean something different. They actually don't mean anything different, but most of the time if students think about what they know about debit and credit, they actually get them backwards. So remember, there's two parties to an account. So this is party one and this is party two. Okay, so when you pay cash, your cash subtracts. Okay, but the business's cash adds. So you over here receive something in the mail from the business. The business describes that cash transaction or the accounts receivable transaction from their point of view. You're reading it from your point of view, okay? So generally speaking, since it's written from the business point of view and you're reading it from your point of view, when you switch to accounting, sometimes you get yourself backwards on debits and credits because you're used to reading it from the opposite point of view, and we're making the journal entries here. So when they credited your account, okay, or let's take the bank side. When the bank makes a deposit in your account, I'm going to go down here, your cash goes up. Okay? However, they may say checks and debits, deposits and credits. Well, we think of it from our point of view, but for the bank, when you write a check, the money is going out of the bank. Okay, so it's a negative on the bank side. So that is written from the bank's point of view, but you're reading it from your point of view. Okay, and so sometimes it can get opposite. Okay, so let's clear that. Okay, so just think of debit and credit as left and right, and that's it. Okay, so just forget what you know about them, and etc. Okay, so notice we have debits on the left, credits on the right, and then we have a balance. So in the ledger that I showed you, the balance was out here every single time, and all of these were underneath each other, but we are going to keep one side and two sides. The reason you keep two sides is it's less error prone when you write things in one column for negatives and another column for positives. So if we mix these all together and put negatives and positives, etc., it's been shown to be more error prone. So if you write all your checks on one side and all your deposits on another side, you have less errors. So that's where that comes from. Okay, here's an important rule, the accounting equation. Okay, I don't see accounting equation here, but I would encourage you to write it out. The accounting equation is assets equals liabilities plus owner's equity. And we're going to go down here and fill this in, although you're going to see it later. So I want you to fill this in and make sure you write debit and credit. So write debit and credit. Debit's abbreviated DR, you can abbreviate it DB, but it's got to do with its Latin roots there. So debit and credit, debit, credit, debit, credit, okay? All right, so assets, if you can remember, the assets are increased on the debit side. So assets are increased over here, which means they're decreased over here. So if I get cash, I put it on the debit side. If I get land, I put it on the debit side. If I get rid of cash, I put it on the credit side, etc. Now, if you can remember that everything mathematically this has to equal, so everything on the other side of the equal sign has to be opposite. So liabilities are increased with credits, and owner's equity are increased with credits, and they're decreased with debits. So make sure you write all those out. I'm going to go ahead and fill this out, although it's going to be talking about later. Think of these as transparencies. These are sub-accounts of owner's equity. So remember, owner's equity has capital stock, investments by owners, and retained earnings. Retained earnings has revenues, that's an R, and expenses, okay? So these are kind of, we keep track of them for the year. We keep track of them for a year, and then we report. So I have, the more revenues I have, ask yourself, does owner's equity go up or down? Okay, so the more revenues I have, the more owner's equity goes up, so we keep track of revenues on this side, on the credit side. So debit and credit over here too. The reason I don't put a plus is because when we get to expenses, putting a plus, which does a subtraction, is a little confusing. So the more expenses I have, the more owner's equity goes down, so expenses are on the debit side. And dividends are withdrawals from investments by owners, so they make owner's equity goes down. Because of the separate business entity concept, the business is separate from its owners, so we're taking it out of the business and the owner putting it in their own pocket, so I'm moving it from the business to the owners. So make sure you know that. That's going to become very important. Okay. Okay, and you can kind of read through those. Read through those, etc. The journal is the book of original entry where we record the transactions. It's in chronological order, and every time I record something in the journal where I increase cash and increase owner's equity, I have to go back to the ledger and post it on those specific pages. Please read through those. Okay. Let's see here. Okay, so we're going to go through these transactions. These are down here. And make sure you look at this as you go and practice these as your own, and go to the extra practice assignments online and do those. Okay, so on January 1st, McBride and his family invested $80,000 in exchange for capital stock. Okay, so what happens? We're just going to put this part of it right here. Okay. Here's a couple rules. Debits always come first. Have the two columns. Make sure that, if you want to, you can draw the T account there and have a debit side and a credit side. But anyway, just make sure that debits are on the left, credits are on the right. If you line these numbers up, there's no way anyone can tell if it's a debit or credit. Okay, so what happened? Notice I'm recording the entries for the business. So I asked myself, what did the business get? The business got cash, so I debit cash. Why'd they get cash? Because of an owner's investment, so I credit capital stock. The 8,000 shares are put in the notes to the financial statements, and so we don't record anything but dollars in the financial statements. So I'm going to debit cash and credit capital stock. Now go down here, and I'm going to probably forget to do some of these, but put an $80,000 on the debit side for cash. And let's go to capital stock. Can't find it. There. And go to capital stock and put $80,000 on the credit side for capital stock. Okay, so this is what a ledger really looks like. So notice I just put it on, this is cash. They put it on the debit side, so that's the ledger right here. Okay, I'm making just this part of it. Here's my T account. It's the part I kept because I can do the balance at the end. Okay, so I'm going to put it on the debit side for cash. And then go to capital stock right here and put it on the credit side. Okay, so right now we have a debit to a journal entry. This is the important thing. Your journal entry should just look like this, cash and capital stock, and your balances at the bottom should look like that. Okay, so overnight, this is long, I just summarized it. Overnight purchase land for $52,000. Ask yourself, what did we get? We got land, so I'm gonna, land as an asset, so I debit assets. So hopefully you have this in front of you. Okay. If you don't, you're probably not practicing right, I'm just saying. So I got land, and land is an asset, so it's debited, and I got it by paying cash. Cash went down, so I credit cash. And now I go down to my T accounts below and put a debit in land and a credit in cash for $52,000. Notice I could do a balance right now, but I'm just going to wait until the end to do all my balances. Next one, they purchased an abandoned building. The purchase price was $36,000. They paid $6,000 cash and a note payable for the rest. So what did I get? I got a building. A building is an asset. It went up, so I debit building. How did I get it? I paid cash. Cash is going down, so I credit cash. And I issued a note payable. A note payable, I owe something, so things I owe are liabilities. And if you go up here, liabilities are increased on the credit side. So then I go down and post them as follows. I add $36,000 to building, credit cash for $6,000, credit notes payable. Quite frankly, if you get through all your postings and put them on the quickly on the right side, you're pretty good, because that's very error prone. Okay, next one. The new asset, tools and equipment, is acquired at a cost of $13,800. So what did I get? I got tools and equipment, which is an asset. Assets are debit. How did I get it? It says liability of accounts payable is incurred, so I'm not paying for it now. If I was paying for it now, cash would be going down, but I'm paying for it later. Whenever I'm going to pay for something later, it's a liability, so I credit accounts payable. And then I go down in my T accounts and post them as follows. Next one. Notice these transactions should be familiar. They're just kind of like chapter 2. I sold my tools of $1,800 because I bought too many. So my tools and equipment, which is my asset, is going down, and my accounts receivable is going up because I have a promise of a future benefit. I'm going to receive something in the future. So I debit accounts receivable since it's an asset, and I credit tools and equipment, and then I go down and post them. Next one, I received $600 from that accounts receivable. So what did I get? I got cash. I will tell you, if you ever get confused in a journal entry, kind of look for the cash. And cash, remember, goes up with a debit and down with a credit. And again, when I was learning this, I actually wrote that on this thing on a separate sheet of paper and just had it side by side, so I could just refer to it until I learned it and learn that really quick. But anyway, so cash is going up. Why did I get that cash? Because somebody that I was going to receive money from paid it. So now I need to reduce accounts receivable. So notice the running total of how much people owe me is now $1,200 if I made a balance in that. Made a partial payment of accounts payable to Snappy Tools. If I went down to my ledger account for accounts payable, I'd see I owe $13,800. Now I'm paying $68,000, so I have to take it out of accounts payable. But even if you didn't know that, notice cash. I made a payment for cash. Okay, so cash is going down, so I'm going to credit cash. Notice my debits always come first, so I had to leave a blank line there. So I'm going to credit cash for $6,800 and debit accounts payable because my running total of how much I owe people is going down. So if you look at this up here, account liabilities are increased on the credit side, decreased on the debit side. Okay, so this shows you that the T accounts are basically a simplified ledger. The overheads do an income statement. So look at the T accounts and think of what your revenues and your expenses have been. I don't think we have everything to do this. But if I did an income statement, yeah. I'm honestly not sure why they put it in here because we don't have the transactions to do this income statement here. But all these transactions would be, don't have an income statement, haven't done anything yet. But this is what an income statement looks like. I probably need to change this. This is look at two key accounts and look at think about your revenue expenses. We have zero. We have zero in our revenues and expenses right now, so we wouldn't have an income statement. So I'm not really sure why they did it. Okay, back up to some of your definitions up above. The accounting period is the time period covered by your income statement. So in this particular one, they did for the year ended December 31st, 2018, and I believe we are probably in the next year, 2019. That's why we don't have anything yet. Time period principle. So we want to compare things a year to a year. You don't want to say, hey, I had a great income statement, but last year I only kept track of it for 12 months, so I wanted to look better, so I added 2 months to my income statement. So that just doesn't make any sense. So that's why we have a time period principle. Fiscal year, not all businesses have a year end on December 31st. I usually pretend that our year end is December 31st, mainly because we're all familiar that August is the 8th month and February is the 2nd month, and once you change your year end, the things that you kind of know in your head, like what is the 8th month, becomes really complicated. So I usually use a December 31st fiscal year end. Businesses pick fiscal year ends with a variety of reasons, but the biggest way to choose your year end is because it follows your business cycle. So for instance, every college that I know does not have a December 31st year end because it would split the academic year. College year ends are usually at the end of May, the end of June, or the end of July. So similarly, you also pick it when you're least busy, which makes sense for that. But if you think of stores that would sell throughout the Christmas season, they probably don't have December 31st year ends just because they're so busy right then. So they would postpone it to January or February because that would be their business cycle. Okay, revenue. We've talked about revenue before. Revenues are what we're in business for. So if we're in business to mow yards, if we're in business to make sales, etc. And a realization principle says, when do we actually recognize the revenue? And it's very important that you know we recognize the revenue at the time the goods are sold or services are rendered. Okay, you do not wait until you have the cash in your hand. So that way we can have a sale that on accounts receivable. Also, you record it when the sales value of the goods or services could be measured objectively. In Principles of Accounting this semester, we really don't get into any complicated items of how much revenue should be recognized. But if you delivered something to a customer and they got to return some, et cetera, and you really didn't know how much you're going to sell, you would have to wait until you can measure it objectively before you record the revenue. Expenses are costs of doing business. So you can see some of the expenses that you would have. The matching principle says I want to match my revenues and expenses with the time period that they pertain to. So here's a good example that I usually use in class. So let's say that on October 1st, that's a 10 right there. On October 1st, I decide I'm going to fly home for Christmas. Okay? On October 1st, I buy the airline ticket. I'm going to fly home for Christmas on December 15th. A lot better with my numbers there. So let's say the airline ticket is $500. And I'm going to fly back to school on January 15th. Okay? Here's the question. When does the airline recognize the revenue on that? So here's when you bought the ticket and it was non-refundable. Here's when you flew home, here's when you came back. And the answer is because of the matching principle, I want my revenues and my expenses in the same time period. So basically, if I want to, generally we only talk about the year, so here's the year end. Okay, so basically we paid the pilot to fly him, we had all the expenses for the pilot here, and we paid the pilot here. So the answer is I recognize $250 on December 15th, and I recognize $250 on January 15th. I recognize half my revenue when half of the expenses were incurred, and I recognize the other half here. So you're going to see in chapter 4, we have to, since we got the cash here, we're going to have to do something with that. But for our purposes, the matching principle says since the expenses to earn that revenue happened on this date, that's the day I record $250, and the expenses happened on January 15th, so that's the date. Sometimes we don't get real picky about days because our financial statement covers an entire year, so we're really kind of more worried about the year it happens than the day it happens, but in that case, we have some days, so we can go with that. Okay, so sometimes we have to split the periods, just like the airline ticket. That's what they're talking about there. Accrual basis of accounting is just that. We don't recognize it when the cash happens. We recognize it when the earnings process happens. So, for instance, if I have some workers that work the last week in December and the first week in January, but I pay them in January, I would recognize half the expenses in December even though I'm not going to pay them later. That's the matching principle. Cash basis of accounting is not permitted under GAAP. The reason a lot of people get fooled is because the cash basis of accounting a lot of us use for our personal income taxes. The reason the IRS allows it is because it's easier, and in tax simplification, we want to make sure that everybody can do it and people can file their own taxes. So they allow the cash basis of accounting for individuals, not for corporations. Okay, so we'll talk about this in the next chapter. Okay, so we already filled out our revenues up here. Okay, revenues are increased with credit. Expenses are recorded as debits. I shouldn't say increased. I really want you to have a check mark here. Revenues increased on the debit side. Expenses on the credit side. And you can see how it flows into owner's equity there. Dividends reduce owner's equity of the business because you have it in your personal pocket, not in your ownership of the business. So dividends, you debit for increases, you credit for decreases. I usually just put a check mark on that. Okay, so now we're going to do some of our income statement transactions. Revenue of $2,200, all of which was received in cash. So I asked. It's like I missed that one. Okay, write that above, and I'll make sure that when I fix the overhead when I post it. So January 31st, recorded revenue of $2,200, all of which was received in cash. So I'm going to debit cash and credit repair services revenue. And again, you should have that, so I'm going to fix that when I get done here. Wages to employees, again, you will have that. Wages expense, and I credit cash. Utilities expense, I'm not really sure why I don't have any of those. I debit utilities expense. Utilities is the cost of doing business, and so I paid $200 and I credit cash. I missed all these. So February 1st, looks like I missed 3. Okay, you will have them, so make sure you record them, and you post them in these ledger accounts right below. Okay, so the cost of, I paid $360 for advertising. Advertising is a cost of doing business, so I debit advertising expense, and cash went down, so I credit cash, and now go and post them. Purchase radio advertising to be aired in February. The cost was $470, so advertising is cost of doing business, so I have an expense, and I'm not going to pay for it until later, so I credit accounts payable, which is a liability, and I go post them. Purchase various shop supplies for $1,400 due in 30 days. So what did I get? I got shop supplies. I'm going to pay in 30 days, so I'm not going to pay now. So I have a liability, accounts payable, going to pay later, and go post them. Should I have all these? Collected $49.80 in cash for repairs made to vehicles. Don't forget what I'm in business for. I'm in a car repair shop. So this is what I'm in business for. So what I'm in business for, it's my revenue, and revenues are credited, so I skip a line and record my revenue, and cash is going up, so I debit cash. And then I go post it. February 28th, 5400, billed Harbor Cab Company, 5400 for maintenance and repairs. And again, this is what I'm in business for, so what I'm in business for is a revenue. So I credit repair service revenue, but they are not going to pay me until March 10th, so I'm going to receive the money from them. So I have accounts receivable, which is an asset. So you're going to say things like, accounts receivable is an asset, it's going up, so I debit it. Service revenue, I earned it, revenues are credit, so I credit it. February 28th, I have my employees earned wages, so wages is the cost of doing business, so it's an expense. Expenses are debited, and cash is going down, so I credit cash. So I post it to the accounts. I paid $1,600 for utility bill. The amount is not due till March 15th, so I'm not paying it yet. So utilities is the cost of doing business. Expenses are debits. I'm going to pay it later. That's a liability, so I credit it. And I know I'm going pretty fast, but you can always pause it and go back and listen to it. But otherwise, if I talked really slow, it would get kind of boring for some people. Not that this isn't the most exciting thing in the world. Okay. All right. Where's my dividends? Okay. So I declare and pay a 40-cent dividends. Dividends have their own special account. You recorded them up here, and it's on the debit side. So I have dividends. And cash is going down, so I credit and go post in the account. So now what I want you to do is take a second and draw a line under each of these, add up the debit side and the credit side, net them, and put the balance on the side that's more. Okay, so notice they have you probably didn't do a January 31st balance, but if you add up all your debits and add up all your credits, we should have a balance in cash. Okay, so then what we're going to do is we're going to do what's called a trial balance. A trial balance simply lists all these accounts and the balances you wrote below. So you should have added up your debits, added up your credits, netted them, and you had debit more on the debit side. For the most part, you'll probably, in this class, you'll always have the normal balance. So all your assets will end up with debit balances, all your liabilities credit balance. However, there are times when you can have a cash overdraft, so you're going to have credit balance in cash because we have an overdraft thing. Okay, so we're going to list them in the trial balance. Make sure you put it down here. So your trial balance, you should write cash here. This is your debit side. This is your credit side. So cash has a balance of $1,320, and they're going to come from these balances right in here. Okay, the trial balance is just that. It just proves your debits equal your credits. Didn't really prove much more than that. When we did things by hand, trial balance really kind of double-checked our errors that I didn't go up here and put it in the wrong column, etc. Now we just usually, our computer just does this posting for us and this. So we spend most of our time in here doing this. This is where the brain work happens up here. And even some of these computerized accounting systems can do the routine transactions for you. So like if I have tons of sales, I can just enter the sales price and it can enter it for me. Okay, If you have errors in the trial balance, which you will, just a couple things. Get the difference down here of your debits and credits, divide it in half, and look for that number. Because if I put a number on my credit side that was supposed to be on my debit side, my credit, let's say it's 200, my credits are 200 too high, and my debits are 200 too low, so that difference will be $400. If the error is divisible by 9, mathematically it's just, that could be a transposition, so you record 42 as 24. Okay, so you can see that computers increase that. And that's it. So I hope you learned something from this, and again, you really need to practice. So go to your online homework and look at the practice problems and walk through them. It's just, you'll get used to it.